David, thank you very much for joining us this morning. Take us through the reaction and whether or not it is too much or too little, given the story you heard from FedEx yesterday.
Sure. So, and thanks for having me. I think the reaction is a little bit overdone. They did bring down the full year guidance, as you mentioned, but only by about 2 to 3%. So the first quarter is really, really weak. Not a lot to be happy about in the results. But we read this more as a delay in some of the structural cost takeout in what is usually a seasonally softer quarter, in a period where the cyclical weakness that we all know about in terms of PMI being in contractionary territory for the last 12, 13 months, shippers trading down to more economy services, having a negative impact on yield. And all those cross currents just left us well below what we would consider to be normal seasonality. Second quarter is also going to be a little bit on the softer side when you think about how the earnings normally build throughout the year. But as you get into the back half of the year and they catch up on some of those structural cost takeouts, we should hopefully be past some of this cyclically weaker soft period, and then you can start to get back on track to earnings. So they are bringing down the first half of the year quite a bit. Back half of the year, less so. They still remain optimistic they can catch up on some of those cost takeouts that were delayed. So we remain optimistic here, and we would be buying any weakness, especially if it's going to be down as much as it is indicating in the pre-market here.
You know, David, one of the things in the past that has been a concern or a focal point for investors with the FedEx story has been the product mix and the growth mix between ground, between express, between certain key parts of that logistics operating system. Have you heard anything that makes you a little bit more concerned? I know that you are saying buy the dip and use that opportunity, but do you think that the mix is positioned properly given what you've seen from FedEx?
Well, mix is always something that's really difficult to model with these companies. And I think what you're seeing right now is, again, an expression of where we are in a cycle as much as where we are in terms of some structural trades and mix. I think it's more cyclical than structural, especially when you think about shippers going ahead and pulling freight out of a priority service and into an economy service. That typically happens during periods of economic weakness when you might have a little bit more inventory, when you're not necessarily willing to pay up for that speedy offering. But so I do think that as we get past this period of time and you start to see the impact of Fed rate actions in the beginning of an easing cycle, spurring some economic activity, you'll see some of that pressure on trading down move away. Now, the company's also going through this effort to integrate their express and ground operations to make them less exposed to those types of trade downs. Because when they were running a separate express network, that has a cost structure that is really sensitive to trade downs. Once they get past that in the next couple of years, I think you're going to be in a much more resilient place. And I would say overall, if you were thinking about this as a business and that you wanted to be investing in, the multiple right now, 12, 13 times, is not priced for perfection. So I think the stock has been doing pretty well amongst large cap transports, will continue to do well amongst large cap transports because it has the structural cost story. It's not aggressively priced in the marketplace, and it should benefit as we get out of the economic doldrums that we're wading through right now.
David, we got just a couple moments left here. I'd like to get your take really quickly. When it comes to FedEx or UPS, which would you rather? And UPS has been such a laggard for so long versus FedEx.
Sure. I think both these stocks have been suffering from a lot of different factors. I think with this move lower right now, you're looking at an opportunity inside of FedEx that probably doesn't last that long. So there's probably a shorter term trade opportunity. Both companies are levered to essentially the same idea. Will UPS and FedEx be more disciplined on the pricing side? We did hear from the company that they are matching UPS on peak season surcharges, that they are going to continue to push on price as a lever to extract the value that they need from the shippers that are willing to pay for their services. So I think that same core thesis is there. Income-oriented investors are going to be more attracted to UPS. Growth-oriented investors are going to be more attracted to FedEx.